So you want to retire in 10 years. Who wouldn't want to retire in 10 years? That is a great goal to have. But like any goal we have to have a plan, right? Welcome back to another episode of the MD Investor. So in today's episode, we're going to look at retiring in 10 years, right? So we have a finite 10-year window. We have a period of 10 years where we want to do certain things, make certain things happen by following our plan. So hopefully at the end of 10 years, we have the cash flow or the portfolio of assets to enable us to do that. Welcome back to another episode of the first thing we want to do on our path to retiring in 10 years is figure out how much will we need to live. Yeah, we need to figure out how much will we need to live. Why is that important? That's going to important. Why is that important? That's very important because that's going to tell us how much assets we will need to sustain the lifestyle, right? It's one thing if you want to live on a bare minimum, right? I just want to eat rice and beans. I'm not going to go anywhere, and $25,000 is all I need. Versus someone who wants to have a more robust retirement, and they want to travel, and they want to eat at a nice restaurant, and they may need $100,000 a year to live that lifestyle, right? There's two different extremes. So how do we figure that out? How do we figure out how big our portfolio needs to be? Well, we try to figure out the expense we will need annually. The expense we'll need over 1 year period. And that's going to include housing, transportation, food, travel, right? And all of that has to be come together. Healthcare, that's a big thing during retirement, right? So housing, are we going to downsize? Are we coming from a home that we already have that we can sell, take the proceeds, downsize, right, into something smaller, and then maybe have a little cash left over? Maybe some people are coming from apartments that they don't own. So people come from different places, right? But definitely housing is one of the big things. Healthcare is another big thing. How are you going to pay for your healthcare? Are you relatively healthy, or you have chronic medical conditions? What kind of insurance do you have? What's your copay? There's a lot of things that we have to take into consideration. Leisure. Some people are going to want to play golf. Some people are going to want to travel. You have to take that into consideration. Some people are not going to want to travel, right? So after you plug all these numbers in and you get to the amount that you will need to live annually, or if you get to the amount you'll need per month, then you multiply by 12. So you'll get to the amount that you'll need annually. Let's say the amount you need to live is $50,000, right? I'm just using that number, right? It can be a different number for everyone. How big does your portfolio need to be? Well, you will multiply your annual expense by 25. And that'll give you the amount you will need in your portfolio. Let me explain. This all goes back to a study called the Trinity study, in which they looked at various portfolio compositions, right? So 75% stocks, 25% bonds, 50% stocks, 50% bonds, different correlation. And they found that with a portfolio of, I think, 60% stocks and 40% bonds, you can withdraw 4% annually and you will never run out of money. That's what the study says. So that 25 comes from the 4% study, right? So 100 divided by 4 gives you 25. So you take your expense of 50,000 in our example times 25, you come up with $1.25 million. That's how big your portfolio would need to be. But whatever your expense is, you multiply that by 25. Okay? So This would give you how big a portfolio you'll need. So it kind of gives you a starting point. We have a 10-year window. So we have a 10-year window, and the assumption is we're starting from zero. Even though in reality people start from different places, we assume we're going to start from zero. And you need to, in our example, accumulate a portfolio worth $1.25 million. At least that gives us a starting point. We know our expenses annually is $50,000, which means our monthly expense is going to be about $4,000 and change, maybe $4,500 a month or so. So we know we need income coming in of about $4,500, somewhere around there. Okay. So the other way in which we can retire in 10 years is if we have passive income coming in of about $4,500. All right. So that is the starting point. This can be done several ways. One way in which you can do it is to invest into the stock market and accumulate assets of $1.25 million in our example. And then we can withdraw about 4%, and that would be about $50,000 per year. We know there's going to be some taxes, most likely, but for now, we just got to ignore that. So here we are in my computer on NerdWallet's compound interest calculator. So before we said, assuming we want to earn $50,000 annually, and we're trying to build up a portfolio to support us during retirement, we try to retire over a 10-year period. And we're assuming we'll invest, let's say, for example, in VOO, the S&P 500 Vanguard ETF, right? We said it normally gives about 10% rate of return. How much would we have to invest to bring this total balance up to about $1.25 million? Right? We only have a short window, only a 10-year period. Let's try $5,000. We know we're gonna need to grow our money quickly, right? We only have a decade. We only have a 10-year period. Our initial deposit is zero. Let's say we're investing $1,000 per month. We're getting a 10% return. We only have 10 years. We know money grows fast or longer, but we only have 10 years. We only have $204,000. And we said we needed about $1,250,000. Let's try $3,000 per month, getting a 10% return in VOO. It's better, but we only have $614,000, right? And we said we needed about twice that much, about $1,250,000, $1.25 million. Let's go to $6,000. So at $6,000, getting 10% return over a 10-year period, we have $1,229,000. We're a little short. Let's try a little more. We're almost there. Let's try an extra $100. $6,100. $6,100 a month. Give a 10% rate of return. In 10 years, we'll have about $1.25 million, right? Just about there. $1.25 million. We're pretty close, right? But look how much we have to invest. $6,100 per month. Most people are not going to have that. And that's why we say that the earlier you start investing, the better, right? I'm just going to give you options. You'd have to invest $6,100 in the S&P 500 index, like VOO, to acquire $1,250,000 over a 10-year period. Let's try to change some of the variables. $6,100 is a lot of money. Most people can't afford that. But we're gonna leave the 10. We're gonna leave the years of good at 10 because we're trying to hold ourselves to 10 years. And we know the rate of return is about 10% for the S&P 500. But what if we invested in something that gave a higher growth? Right? We have looked at growth ETF before, such as Vanguard's VUG. Vanguard VUG. Over the last 10-year period, they've averaged 15% return. So let's say we're investing into VUG with a 15% return. with a 15% return, in VUG. Let's see how much we could invest to get our $1.25 million. All right, hopefully less than, we should need less than $6,100. Let's go to $5,000. So at $5,000, if you get a 15% return, we're over $1.25 million. So we could invest a little less. Let's go to 4,500. With $4,500 getting a 15% return, we are right in the neighborhood of we're right in the neighborhood $1,238,000. So probably $4,600 will probably do it. $4,600 will pretty much do it for us. So we came down from 6,100 to now $4,600. We could probably do a little less, but you see about $1,500 less because the rate of return is better. Now, Vanguard had a technology ETF called VGT that have only technology stocks in there. And over the last 10 years, it's given a return of 20% average over the last 10 years. 20% return, which is great. It's a little more risky because it's less diversified. But with a 20% return, we should be able to invest less. Let's try $4,000. $4,000 a month, and you're already at $1.5 million. Let's try $3,500. $3,500 a month, and you're at 1.3 million, right? Let's try $3,400. $3,400, and you're pretty much in the neighborhood, right? 1,270,000. So you see, when the rate of return is higher, you obviously can invest less money. But of course, it's more risk. I'm going to give you options. So you can invest as low as $3,400 a month in something that gives you 20% return, and in 10 years you would have $1.278 million, which would be enough by the 4% rule for you to take out 4% annually, and your money hopefully never run out. But again, this is less diversified. With a 15% return in VUG, you needed to invest about $4,600, and with 10% return in S&P 500, you need to invest $6,100. That's because we are limiting ourselves to a 10-year window. So we showed that we can build up a portfolio and just take 4% every year and live off that based on the 4% rule. The other way that we can build up a portfolio and live off the passive income from the dividend. For example, we can live off the dividend from an ETF such as VYM, which is Vanguard High Dividend Yield ETF. Build up a portfolio and then live off the dividends or the cash flow every year. So VYM is an ETF which basically holds dividend companies that pay higher than average dividend yield, right? So it seeks to track the performance of the FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yield. So let's take a look at this ETF. The 1 year return has been 18.3%. The 3-year return has been 9.5%. The 5-year return has been 10.6%. And the 10-year return has been 10.12%. So the 10-year return of VYM has been about 10.12%, right? We see the expense ratio here is 0.06, right? So you can pay about $6 for every $10,000 invested. Let's look at the composition. It holds about 557 stocks. The median market cap is about $126 billion. So let's look at the sectors. We have financial at 20.4%. We have industrials, 12.7%. Healthcare at 12.4%. energy at 10.6%, consumer discretionary 10.3%, consumer staples 11%. Everything else is in the low to mid single digits. Top 10 holdings: JP Morgan Chase, Broadcom, ExxonMobil, Home Depot, Procter& and Gamble, Johnson & Johnson, Merck, AbbVie, Chevron, Bank of America. It does pay a dividend, um, and it's quarterly. The last dividend it paid was about 65.5 cents, and that's quarterly. So that's VYM. So you can buy um, stock in that ETF. Now let's look at the dividend growth of VYM. So the 10-year dividend growth for VYM, the dividend has been growing pretty nicely. The annual dividend growth for VYM year over year, going back to 2013, or like 10 years ago, it's been 9.7%. It's usually in the high single digits. Usually in the high single digits. They did get to 12. They did get to a double-digit dividend growth year over year in 2015, 2018. But for the most part, it's in mid to high single digit, the dividend growth. Now let's look at the growth of the share price. That's important as well. So over the last 10 years, VOM share price has grown by 82%. So if you divide 82% by 10, it's grown about 8.2%. So the share price has grown about 8.2%, and the dividend have grown about maybe high single digits. So let's take a look at this at our dividend calculator. So imagine we have VYM here, and it gets quarterly distribution. We're going to do the dividend reinvestment. So let's say we're starting off with zero number of shares. Share price is $115 right now, and we're going to put in $12,000 a year or $1,000 per month. That's the initial annual dividend yield. The expected annual dividend amount increase every year is about 7%, and the share price is going to appreciate 8% every year. And we're looking at 10 years. We're going to calculate our dividends, and after 10 years, our annual dividend income is going to be about $5,000, which is a lot less than we need. We said we need about $50,000. Now, let's look at making adjustments. Now, let's increase our annual contribution to $3,000 a month. So that'd be $36,000 a year. Now we're making $15,000 every year in dividends. Still not enough. $15,000 a year in dividends is not enough, right? After 10 years, our annual dividend is only $13,000. So let's see if we can increase that. Let's go to $60,000 a year. $60,000 a year, or that's going to be $5,000 every month. And still, our dividend is only $26,000. That's only half what we need. So you can tell, obviously, already that we're going to have to crank this up. We're going to have to crank this up to about double, $120,000 a year, which is $10,000 a month. $120,000 a year, which is $10,000 every month. That'll give us our $53,000 in annual dividend, and we wouldn't have to sell our assets, our underlying assets. And the assets of value has grown to almost $2 million. But $10,000 a month is a huge amount, right? $10,000 is a huge amount to contribute every month. And this is why time is a very important factor. If you had more time, we could invest less and it'll grow over time. But the other thing you can do is look at something that is paying a higher dividend yield, right? Let's look at a stock that's paying higher dividend yield, something like Altria. Altria Group, it's an individual stock. It pays quarterly. Right now it's about $42 a share. It's paying a 9.31 dividend yield. That's a cigarette company. That's a higher yield, right? The amount of the growth of the dividend is only 4%. It's not going to grow as much, but you have a very high starting yield. So let's take a look at that. We're going to look at starting off with zero number of shares, and we're going to look at only 10 years. We'll look at the initial yield of 9%, right? And then look at our annual contribution. We'll start at $12,000 per year. $12,000 per year, which is like $1,000 per month, and see what that gives us, and then we'll go up from there. So at starting off with zero number of shares, and $1,000 a month, or $12,000 every year. We have an annual dividend income of $22,000, almost half what we need. We said we want about $50,000, right? Now let's go to $3,000 a month, or $36,000 a year. $36,000 a year, which is $3,000 a month, and we take a look. Now we have the income that we need, $67,000 annually in dividends to live off. Our ending balance after 10 years is about $625,000. So right there we have the dividend income we need to live off. However, let's look at our share appreciation. So this is doable. This 10 years with Altria is doable. If we invest $3,000 every month into Altria, $3,000 every month, after 10 years, we will have $67,000 in dividends, right? After year one, we have 830 shares, and we'll just keep buying. After year 10, we have 11,000 shares, and we're getting annual dividend of that'd be $54,000. And our portfolio value is about $625,000. Over the last 10 years, it's only been up 7.62%. So not much movement over the last 10 years, less than a percent per year. So the capital appreciation has not been there, which makes sense because a lot of people are smoking less. So the dividend is good, but the capital appreciation is not great. That's a problem sometimes with high dividend yield stocks. Their dividends go up, but their capital appreciation don't. So that's something we have to keep in mind. So we can build up a portfolio over that 10-year period and then withdraw 4% based on a 4% rule and live off that. We can invest in something like an ETF, like VYM, and live off the dividends. Or we can invest in an individual stock like Altria and live off the passive income from the dividends as well. There's some pros and cons. Again, like right with the ETF, you have more diversification. Over 500 stocks, like in VYM, with one stock like Altria, this is one company, and you have more risk because it's a single stock. Another way to retire in 10 years would be rental properties, right? You can buy a rental property, and let's say, for example, after all expenses, property tax, insurance, utilities, professional services, all expenses, you're cash flowing, say, $1,000 a month. And if you have 5 of those properties, you'd be cash flowing $5,000 a month. That would be the cash flow you would need to retire, right? And there's a multitude of ways in which you can prepare for retirement. One, if you need $5,000 a month, for example, to retire, you could maybe get $2,000 a month from dividends. And then maybe you can get $2,000 a month from rental income. And then maybe you can get another 1,000, for example, by selling some of your portfolio, right? Maybe less than 4%. But that's a way that you could bring it together to get to retirement. Not to mention the things we haven't talked about, such as a pension if you have one, or Social Security. All that could add together to help to give you the funds you need to retire. So again, guys, the MD Investor with another video that's to kind of increase that financial IQ so we can break the cycle of generational poverty. Don't forget to subscribe on YouTube, and I'll see you on the next one. MD Investor out.